Well, hello and welcome back to Wade into Wealth. I'm Chuck Wade and joined as always by my brother Ethan Wade. And if you're with us on YouTube, I guess we got the dueling pinstripes going today.
Well, neither one of us were blessed with height, and we know that
No.
pinstripe suits help make you look a little bit taller. So
No.
we'll take anything that we can get.
I doubt you'll ever find one of us wearing a suit with horizontal stripes.
No.
I don't know that they make them, but
Well, they'll make anything.
But anyway,
they'll make anything.
Yeah,
but
and
we'll stay away from them.
If you are with us on an audio-only version, you've got the visual now, and you're welcome in advance for that. Today, we thought with back-to-school season upon us and school starting up within the next couple of weeks, it was good to talk about saving for education. It's something we talk about with clients a lot, ways that you can do it, tips, strategies, things to be on the lookout for, and the majority of this happens inside of what's called a 529 plan.
That's right.
Why don't you tell us a little bit about the 529 plan?
529 often will be referred to some different numbers because clients will say, there's this college plan,
Right.
923, no, it's the 529 plan, which its main purpose is to help save for college. You can, as a parent, or anyone can really open the account, but as a parent, you can put contributions into a 529 plan. As the owner of the account, you have a beneficiary. Typically, the beneficiary is your child or whoever it may be that is planning to be the student in higher education. And you can put the money in today, receive a modest state tax deduction depending on what state that you live in and the plan that you're using. And the money can grow tax-free as long as it is used for a
Qualified
subset
education
of qualified
expense.
education expenses, which isn't as simple as just college. There are other options that they have some loose interpretations of what is allowed as a qualified education expense, but it can be a good tool, especially if you start saving when the kids are very young, to have plenty of time to get a little bit of a state tax deduction, but also have that money and those assets grow free of taxes when it comes time, as long as you're spending it on those qualified education expenses.
The primary objective is, if you are going to set some money aside, why not have it grow? Why not have it appreciate? And you can do that
And be
inside
free of taxes.
of a 529 plan and not have to be concerned with paying capital gains taxes.
Right.
And right now, the average cost of a 4-year public college is nearly $23,000 a year. So 4 years of public college, State University of New York, of which we are both alums, you're looking at nearly $100,000.
It's crazy.
Double it
Yeah.
and more if you're going to a private school. You're talking nearly $52,000 is the average cost. That's average. That means there are a lot of colleges that are significantly higher than that. And for a lot of folks, the 529 is not a vehicle to pay for all of college, but it's a vehicle to help defray
pay for some
of the cost. And in some cases, if you want to start early and you want to be aggressive, you may be able to fund your child's education.
Yep.
Some things that we're going to talk about today, questions that were commonly asked or things that come up in the conversation. One of them is when it comes to applying for financial aid, and one of the benefits that a 529 has is that it doesn't count against the student nearly as much as if they were to have a bank savings account or a custodial investment account. A 529 asset is included in the calculation to determine how much aid a student would be eligible for from the federal government, but only about 5.5% of that. So if you've got, for example, $100,000 in a child's 529 plan, which is a lot of money to have in a 529 plan, only $5,600 of those dollars would count against the student when filling out the FAFSA form, which is an Olympic event in itself.
It is, and that's largely because in a 529, the assets are not considered the students, whereas in a bank savings account or in what's called a custodial account, where mom or dad may have an investment account open for their child, because in a custodial account, that is technically the child's money, and it is their asset that gets turned over to them when they're 21. that's going to count much more meaningfully than the 529, where
Yes.
the parents control it and the student is simply a beneficiary and not an owner of that account. So a custodial account would count 20%.
20%.
In the eyes of the FAFSA calculation. It's tough to say.
Yeah.
FAFSA.
FAFSA. FAFSA. FAFSA. It's not that difficult to say. You just have to say it correctly. FAFSA.
Moving on. 529, a little more advantageous for that process.
Yeah, and one of the questions that will typically come up after someone has had a child.
FAFSA.
FAFSA. It's not that hard to say. FAFSA. One of the things that will typically come up is someone will say, "Well, what kind of account should we be doing? Or we just had our child, it's been a couple of months. We'd like to start setting some money aside." One of the questions I'll first ask is, okay, well, how important is it to you that this money be for education?
Mm-hmm.
Or how important is it that this money be set aside for something, not necessarily education, but so that your child has some money in the future, maybe to purchase a home when they're older or to use for a vehicle or anything really? What's most important to you? And that's how you can start to determine if you should be setting up a 529 college savings plan or a custodial account, which has a lot more flexibility in terms of what it can be used for. 529 really should be used for education. That's what it's made for.
Well, yeah, there's parameters that make it less than ideal if you're not using it for education.
So how do they work? Who can open a 529?
Anyone can. Parents, grandparents, aunts, uncles, family, friends.
Yep.
Anyone can open them.
Typically, and I'm going to make a blanket statement, and we will then kind of work through it to make it a little more exact. Typically, it is most advantageous for the parents to be the ones opening a 529 plan.
Yep.
Often, grandparents will ask, "I just had a grandchild. I'd really like to open a 529. And I'll say, okay, we can do that, but it may be more advantageous for the parents of the child to open a 529. And there are a handful of reasons why that is the case.
Right. And that is one of the biggest ones is because distributions, if the parent is not the owner of that 529, say grandma is, the income off of it would count the distributions would count as income to the students in the eyes of the FAFSA.
Right.
Yep.
So what that means is that in year one, it's not necessarily a big deal.
Right.
In the freshman year, if a child is a freshman at college, it doesn't really matter. But let's say you took $25,000 out of a 529, or a grandparent did.
Yep.
You have to reapply for that for the federal student loan or federal aid every year. In year two, when you're applying, the student would have to list that $25,000
that will count a lot
as income.
Right.
So what is going to happen? Let's say you were eligible for $15,000 of federal aid. There is a likelihood that will be significantly reduced because all of a sudden now the applicant, the student, has $20,000 to $25,000 of income.
Well, that's meaningful income for a college student. And that definitely very, very likely would result in less financial aid.
So that's one thing to keep in mind. If a grandparent is wanting to open, there can potentially be a negative consequence for 529 distributions if the student is receiving federal aid after filling out the FAFSA. Again, not that difficult to say.
Yep.
One of the other reasons that typically it makes a little more sense for the parent of the child to open the plan is that the contributions of up to $10,000 a year for married couples, $5,000 a year if single, is eligible to be deducted on New York State's income taxes.
And we live in New York State, we operate in New York State, so that's why we focus here.
Every state can be different
rules.
Every state determines
different rules. Some are going to be similar to New York State. Some are going to be completely different. And with that, it's important that we note it's a maximum of $10,000 for a couple per year. You can't do $10,000 for Joey, $10,000 for Mary, $10,000 for Sam. It's $10,000 across the board, no matter how much you put in. And it's specifically for a state income tax deduction. Often folks will think you're going to get a federal tax deduction off of that. That does not exist.
No.
It is, if your state allows it, it is unique to your state income tax for that deduction to apply.
To clarify, we are talking about a $10,000 limit. That is what is eligible in New York State for the state tax deduction. You can put more in.
Correct. Oh, yeah.
To the account. I think you can put up to $160,000 a year
I think it may
into a 529 plan.
Yep.
But only $10,000 is eligible for the taxation benefit in New York State. I believe it's around 30 states in the United States have state tax benefits.
It's good clarification, though, because a lot of people think, I can only put in $10,000. No, you can put in a lot more. You're only just your state income tax deduction is limited. Again, right. if you're a married couple, to that $10,000. If you're an individual, $5,000 per year.
And I know of one client that put upwards of $50,000 a year in for a couple of years.
Well, sure, and because
college was taken care of that.
Yeah, and the benefits of long-term growth and being able to use that money free of taxes on any qualified educational expense outweighed the fact that they wouldn't get a state tax deduction. And in all reality, the full New York State tax deduction on $10,000 is fairly modest. I mean, it's $500,
right?
Which it's $400 or $500. That meaningful.
Absolutely.
And that matters. But when we're talking about, you're not doing this specifically just to get a state income tax deduction. That's one of the complementary benefits to it.
Right.
But the main reason is for those assets to be able to grow and not have to pay taxes on those earnings when it comes time for higher education.
And in this case, the client knew there would likely not be much federal aid.
Sure.
Or there would be no federal aid coming. Yep. And that if he was able to put a significant chunk of money in early, it would likely grow to the point where it would cover the cost of education for his children. And it did. So things to think of. So what can the proceeds be used for?
Well, fortunately, they're pretty loose in terms of the items that you can use it for tuition. You can use it for room and board, books, supplies. I mean, I think even a laptop for a new college student would be covered under that. Equipment. And one thing that I think we often, when we think of 529s, we usually only think of college.
Yep.
But you can use it for a trade school. It can be used with expenses
an
associated with attending a private elementary school or high school tuition. Now, there are caps on that.
$10,000 a year, and that's relatively new. That's only within, I think, the last 4 or 5 years that it was expanded to cover private tuition, to be able to use for an apprenticeship program, to be able to be used for a trade school. Often folks think they should not. They tend to dissuade themselves without knowing there is a lot more flexibility, and you can make the case that, and I've had conversations with clients where they've said, well, I've still got money left in the 529. Does your child need a new laptop computer? Do they need a new iPad? Well, you can make the case that those are expenses associated with attending school, and therefore you can use those on the you can use your 529 for that.
So that's a great lead into another part. What if you have money left in the because I had this with a client maybe about a year ago. You have money left in the 529 plan. Your child is done with school, and they're not going to be going to or having education any further that they're going to have to pay for.
Because it can be used for grad school as well.
Correct. Yep. And this student was done with grad school, so completely done with it, still had money left over, and you can take money out of the 529 plan and not use it for education expenses.
You can.
It just means that you then have to pay tax on the earnings that were made inside of the account for that period that's still left. And in addition to the tax is a 10% penalty that is levied on the money that was made, not on the full amount that's still there that you're taking out. So if you had $10,000 that was still left in the plan and you're not going to use it, you're not going to do anything else with it, and you had originally put in $8,000 and you made $2,000 in growth, you would have to pay taxes on the $2,000 and the penalty on the $2,000, not on the full 10. Yes,
capital gains taxes,
not on the full $10,000 that would still be in the account.
That is true.
Well, that's good.
Yes,
it's good.
It is. Now, there are some ways to get around this, and typically, this just leads to us asking the clients more questions. Well, one, did your child receive a full scholarship? Now, that's rare, but if the student received a full scholarship, the 10% penalty is waived.
As it should be.
You're not penalized for being very smart or receiving a full scholarship. Here's a question. Do you have other children that may still be attending college? This is something that often when the second child is born into a family, we'll get the phone call, hey, we just had our second child. We need to open a new 529. You can, but you don't need to, because with a 529, you really only need one because you can change the beneficiary. If you've got two children and your first one goes through school and there's money left over, you can make child number 2 the beneficiary of the 529 plan, and it can be used for their education expenses.
And that comes back to what we talked about in the beginning, where this isn't the students. It's technically not their asset. They are the beneficiary of this account, and it can be used for their purposes. But you can change the beneficiary at any time that you want without having to have tax consequences or any other issues that would come along with that.
Now, what if the child did not get a full scholarship? We can't transfer the money to another sibling, but there's still some money left over. What's the next question you would ask?
Student loan debt.
Is there any existing student loan debt? Because up to $10,000 of student loan debt can be paid off with money in a 529. So if your child had taken out loans to attend college and there's still money left in the 529, up to $10,000 of principal of student loan debt can be used or can be paid off with $529.
You've got options. There's a lot of options, and there's a lot of benefits to these plans. As with everything, there are pros and cons.
There are.
And it's important to have that conversation to understand what, to your point, which was one of the first things you mentioned in the beginning of this podcast, what are you trying to achieve in opening this account in the first place?
Right.
And understanding what your goals and objectives are is going to help provide the direction of if a 529 plan makes sense for you, or if we should be considering some other alternatives as a better potential option.
Right. It's like going into a car dealership and saying, well, I want to buy a car. And the car salesman may say, okay, well, what are you looking to do? If you're looking to go off-roading and camping and driving down, rough road, they're going to put you in a different vehicle than if you're just looking for something that is a sedan. That's why they ask these questions. Something I didn't put on the rundown, but that we need to go over. How do you take withdrawals? That's a question we get a lot because there are different ways to take a withdrawal or a distribution from a 529 plan. So let's dive into that a little further.
Well, some of our clients will give us the exact information of what the tuition bill is, where it needs to be sent, what the student's ID number is, and we can make the checkout payable directly to the college or the school that it's going to, and send that off to them to have the tuition bill paid
to the college from the 529.
Correct. Or what is happening a little bit more frequently is, I remember, it's not that it's happening more frequently, it's just the past couple cases where I've had to do it. We've just reimbursed mom and dad for expenses that they have incurred throughout the education process.
That's typically the way that I have done it with folks. Or they might, in one case, a client said, look, we're going to put it on the credit card. We're going to get the points.
Yep.
We're going to get the airline miles or whatever the points are. And then we're going to reimburse. We'll reimburse with the 529.
Yep.
Keep your receipts.
Yes.
Keep the bill.
Fortunately, electronic banking helps keep everything a little easier.
It does. Now. But if you are using it for not just tuition, if your child is buying books, you need to get a receipt that shows what the cost of the books were. If you're buying a laptop computer, external hard drive, keep the receipts because in the event you were to be audited, you would need to show the expenses that were incurred to reconcile that with distributions that came out of the 529 plan.
Here's a question that we get, or it's often not a question, but it's an assumption, which is Johnny's a freshman in college already. It's a little too late to be saving in the 529. And for the investment benefit, it probably is because it's short term.
Right.
But we have had clients, and we've provided the recommendation that you can use the 529 account as a funnel to still be able to get the New York State tax deduction. Whereas you can put your contribution in, maybe it's $10,000 for a married couple.
Right.
You don't even have to necessarily invest the money. but can turn around and when the tuition bill comes or whatever it may be, use that to help pay for that. You're still going to be eligible for the New York State tax deduction.
This is always a moment I enjoy where I'm like, well, let me ask you a question.
Yeah.
Are you still planning on helping the child with paying for
Right.
college?
Yep.
And if the answer is yes, ha-ha!
Yeah.
All right. Well, what if you put the money in the 529 and just put it into a money market fund and take it out a couple of weeks later?
Mhm.
You just created yourself a New York State income tax deduction. The important part is we don't invest the money. It
Right.
goes into a money market fund. And that leads me to another. How should the money be invested? How are the funds invested in a 529 plan? Good question, Chuck. Thanks.
Yep. Great question. Well, if we're ignoring everything else, we're just simply looking at the natural trajectory that,
Right.
that the investment choice should take. When the child is the youngest, it should be the most aggressive.
Right.
They also have, similar to the retirement, age-based portfolios in your 401k where it becomes more conservative as you have a target date, maybe 2030, 2045, whatever it may be. It becomes more conservative as that date's coming closer
Right.
and closer. They have those age type of investments in 529 plans as well, where you pick, well, Susie's going to be going to school in 20 years,
Right.
and you pick the date that is 20 years from now. Or I believe it actually coincides with the age of the beneficiary
It does.
who is on
They're
the account.
age-based, at least in
So you
New
don't
York
even
State.
have to pick the date. It's just in line
Right.
with the age of the beneficiary listed on the 529.
And
That's the set it and forget it
yes.
strategy.
Every state determines who is going to offer the investments.
Mm-hmm.
So New York State, JP Morgan is the
Yep.
company that offers the investments. And within that, it's very similar to a 401k. You can pick your own investments. There will be a large cap growth mutual fund and a small cap and a mid cap and some fixed income
Mm-hmm.
funds, or you can pick the kind of the set it and forget it portfolio that will automatically become more conservative.
And if
over
you're
time.
not using those and you just have a stock portfolio of it, you may consider making it more conservative as the child is getting closer to needing the expenses, because then it's a conversation of, well, this used to be long-term money,
Right.
and now it's transitioning to being short-term money. And when we know that there is a short-term expense coming up, typically you want to have a little bit less risk associated with
Right.
that capital, because you don't want to get to Susie's going to school and all of a sudden the market goes down 30% and now your 529 account is 30% less than it was
Right.
and you were counting on using that money for the first year.
Well, and even more so than someone who is looking at a portfolio of investments that is to be used for retirement, because retirement typically could last for 25, 30, 40 years. But a 529, college is finite.
Right.
We hope it's
Well,
finite.
hopefully, yeah.
But you're not planning to use that money likely for 10, 15, or 20 years. It's likely for a very short period of time. So what is the potential benefit if a child is 17 years old and about to enter college? Well, the market has a fantastic year and it goes up 30%. What are the odds of that?
Mm-hmm.
Not great.
No, not
You know,
impossible.
statistics say it may
yeah.
make, on average, it might make 10, 11%.
Mm-hmm.
But if your child's 17 and the market goes down 20%, now that you're going to feel and you're going to notice and you're going to be upset about. Because if you had $50,000 in a 529 plan and all of a sudden you have $35,000 in a 529 plan and you need to start using
And then you start
it,
drawing off of it. You're
okay,
taking
right.
out
You've
the
got
potential
35
to recover. Yeah.
and you need to take $10,000 out. Well,
Yeah.
now that $50,000 plan is $25,000 and you got 3 years left of school.
And you wiped out the potential for
Right.
10 of it to be able to recover.
So I would argue even more so than with an IRA for someone who is approaching retirement, you really want to make sure that is getting more and more and more conservative, because when you need it, but you only have a short window of time to really use it.
Yep.
Okay. What are some things that we've learned along the way? Some advice or things that you've seen as you've worked with folks with this that you would say, look, here are some things you can be aware of and keep in mind.
Automate it.
Yeah.
Whenever you can, when it comes to savings or just saving money, automate it. Make it easy for yourself, because you're just going to set it and forget it. What is it, Ron Popeil?
Yeah, he is. Yeah. Rest
Yep.
in peace.
That's right.
The Infomercial cooking guy.
But the reality is, to stop it, you have to physically do something
Right.
to stop it. If you set it up to just automatically put money in every month, every quarter, whatever it may be, it's going to keep happening unless you take action to stop it. The flip side of it is, if you have to take action to put money in, you'll do it sometimes, but other times life is going to get in the way.
Yep.
And you're not going to be able to save as much money as you otherwise would have intended if you just had it set up and ignored it and didn't pay much attention to it.
Yeah. Even if a parent of a child has set up a 529, I think they're great ways for grandparents, aunts, uncles to give a present at Christmas, at a birthday. They can give you a check, and you can deposit it, or you can make an on-demand contribution into your 529. But we'll end with, it's always best to speak with your advisor. And in this case, not all 529s are created equal. We're in New York State, so when we're speaking, it's referring to New York State's 529 plan.
Right.
But
every state is different.
There are 49 other states, and it's important to mention, you do not have to live in the state in which you could set up a 529 plan in Colorado if you wanted to.
I could. I'd give up the right for the state tax deduction.
You would.
Yep.
You would. But let's say that you had you had someone that lived in Colorado that you wanted to set one up for. You could set that one up.
Yep.
For them. So speak with your advisor. It's best to speak with one that's in the state in which you're setting one up.
And have an investment plan.
Yep.
For one, how much you want to save, but two, how are you going to make that account a little bit more conservative as the beneficiary of it, the student, is getting closer and closer to needing that money.
Right. And it's something that is typically not going to be held with the rest of your investments. You can't really set up a brokerage 529 account.
Right.
So it often may be separate from your investment. So yeah, it's always, hey, how's our 529 doing? Should we be making any changes with that? Junior's getting a little older. Should we be making it more conservative? All things to think about. And you're smiling. Why are you smiling?
Junior. I like Junior.
Yeah. Okay. He seems like a nice guy.
He does. Yeah.
Okay.
He's getting older. He's going to be using that money sooner.
Yep. So, hey, that's 529s. A lot to talk about. And if this is something that applies to you, feel free to reach out if you have further questions. As always, we appreciate you being with us and spending the time with us on the journey to financial wellness. Back next week with more Wade into Wealth.